Okay. Okay, do we start or?
Yes, Professor, yes, you can start.
I can start right now. Okay, yeah. Fine. Thank you very much. So, good afternoon, everyone. It's morning here in Paris, but for you, it's already the afternoon. And we have today the session number 4 of this course on financial policy and diagnosis, which is called also FA2 in the schedule. So just a few words first. It was a few days ago, about 10 or 12 days ago now. We went in the first session through different elements, different topics. The first one, session 1, was on financial plan and investment decision. We spent time on the investment decision process, not on the calculations, because you already had a good knowledge of calculations after the course taught by my colleague, Olivier Cozard. Session 2 was more on how to use financial analysis, what in financial policy design, diagnosis, financial analysis brings. It was also a session on the loan structure of loans, maturity, and risk, of course, which is one of the consequences of the structure and the maturity. And on hybrid products, we identified the main categories of hybrid products: leasing, convertible bonds, and also preferred shares. And for session 3, we spent time on one of these hybrid products, which is leasing, with different elements of presentations and some exercises also. We went through the multipliers, the price-earning ratio, and after that, had a discussion, first part of the discussion on dividend and dividend policy, with a definition and the calculation of the payout ratio. And we started at the end of the session an exercise, which is in the past exam, on the costs of debts without integrating the taxes, with the taxes, and taking into account after that the leasing contracts. And we're at that point, So I will not come back on the last 2 questions of this exercise now. I will move to other topics and integrate these topics into the last question afterwards. To start with today, we will go through a few questions. That's what we do usually, coming from past exam, 19 and 20. And we will move to the central topic of the session, which is the equity issues. And after that, either at the end of the session or the beginning of the next one, we'll come back to the calculations of the exercise we started with at the end of session 3. So that's what we have done and what we will do today. So if you come back, if you are at that point, which is what is called PowerPoint 93, just to give you, show you where we were. We went through slides like the cost of debt before taxes. We're here, cost of debt after taxes, okay? After leasing, with leasing and after taxes. And we stopped our calculation at that point, and we'll come back on what calculation later. That's what I wanted to show you, you are clear on where we are in that set of slides, which is a very long set of slides with 34, 3 and 4 different slides. Now we will use today, you know, mainly the 94, which you received from Tram probably a few minutes ago, which is an equity issue. And we will use also, and I start with these two elements, the exams from June 19 and July 20. You already know these exams because were distributed before, and we use them for some questions, some specific points in the last session. So let's go back to one of them. I show you where we are right now. I hope I will find him. I'm not very professional for that, you know. I think I'm right. Yeah, I should be okay. So I'm here with one of the past exams, and this past exam is June 19. And I hope you see the June 19 exam on your screen right now. I think I did what is needed in order you see all these all the pages of this exam. You probably see that here. And to start with, let's have a few questions here. And the first question I want to deal with you today is question number 2, part number 2. It is here on the screen right now. I hope you get it on the screen also. Exam June 19. You see that on the top here of the sheet on the right side, June 19, and it is part 2, question 2. And the question is a very simple and short question, you know, on the tax rate. And it is the higher the tax rate, the lower the average cost of debt of explain and discuss. And it seems to be a very simple question and just a calculation, you know, and that's what we did. Remember, we can make calculation of cost of debt without taxes. And you remember that the cost of debt without taxes should be after that multiplied by 1 minus the tax rate. But we have, and we found in the last exercise 2 different situations. The first one is for profitable firms. The second one is for non-profitable firms. It is clear that for non-profitable firms, they don't pay taxes, and the tax rate after taking into account taxes is equal to the tax rate before. Means you have 0 multiplied by 1 minus the tax rate, it's still equal to 0. So there is no difference for a non-profitable firm before and after taking into account the tax rate. But means the problem is for profitable firms, those firms which are also important for the economy. And when we have profitable firms, of course, if you have, for example, 5% for the cost of debt before taxes, and multiply by 1 minus 0.3, for example, 30% of tax rate, it means you multiply 5% by 0.7, which is 3.5. And you understand that if you integrate the tax rate, tax level, you get a cost of debt which becomes lower than without taxes. And if you increase now, if you increase the level of the tax rate from 30% to 40%, for example, it becomes 5 multiplied by 1 minus 0.4, which is 5 multiplied by 1 multiplied by 0.6, which is equal to 3%. That means when you increase the tax rate, the cost is decreasing, the cost of debt is decreasing. So to summarize, non-profitable firms, no impact of the tax rate. The cost of debts after taxes is equal to the cost of debt before taxes. For profitable firms, the situation is completely different. Of course, the cost of debt after taxes is lower than the cost of debt before taxes. And the higher the tax rate, the lower is the cost of debt. And of course, if you decrease the cost of debt, you have an impact on several other basic elements in corporate finance, which are the weighted average cost of capital, takes into account this cost of debt after taxes. And of course, if you modify the weighted average cost of capital, reducing the weighted average cost of capital level, you improve the net present value of your investment, you improve the global or total return of portfolio of investment of the firm, and the return, different returns, whatever they are, and particularly for the shareholder. Okay. So it is clear that now, if you move from the calculations to the real economic and financial situation and to the policy of a decision maker, so for example, the decision maker being the CFO, what's happened? When you have high tax rates, it's an incentive for the CFO to finance their firm with debt, because they have low cost of debt, of course. When you decrease the tax rate, is compared to equity, it's less interesting to finance the firm through debts. So that means in economies, in countries where you have high tax rates, this is an incentive globally for the financial decision maker, for the CFOs to finance their firm using debt contracts. And this is a signal, and we'll come back on signals on equity issues in a few minutes. This is a signal which is very often in contradiction with the policy of the governments of the states, because you heard about that probably. Many government, Ministry of Finance, for example, they try to make incentives or to develop policies in order that the firm get more equity and improve their debt equity ratio, decreasing the level of debt compared to the level of equity. And they understand that it is less risky, that it is on the long term a situation which is better for the firms and for the economy. But at the same time, they use the tax rate in order to obtain more cash from the firms, and to improve the situation of the budget of the country. So you have a kind of opposition or contradiction between two different incentives. The first one is through the tax rate, and when the tax rate is increased or high, it's to finance the firm using debt. And on the contrary, generally the policy of the governments are in favor of an increase of the level of total equity in the financial structure. And trying to think to the situation in Vietnam or in many other countries, you will find that situation. That is the interesting point here. So you should try, of course, to summarize this answer dealing with this question during the time of an exam. because you have only 10 minutes to write, the main points. So we don't have to go through all these explanations, but to summarize what is the situation for profitable, for non-profitable firm, what is the difference, and what is the contradiction between the two categories of incentives. That's what you really need here. So we were here, part part 2, question 2, in this June 2019 exam. So now I will try to show you another question. I hope I find it. It is in the other exam you get, or you received, and we already use, which is the July 2020, July 2020 exam. It should be this one. No, it's not this one. Sorry for that. I have to find the right one. I don't know where it is now. Zoom is always a difficult tool. Somewhere here. No. No. Sorry, I lost my exam. Yeah, it should be this one. Should be this one. And now we are here with July 2020 exam for another question. And here we have also a few questions of interest, and probably the most interesting question here is part 4, question 2. I hope you see this question on your screen right now. If you don't, just tell me you don't see the question on the page. Part 4, question 2. It is on the cost of equity, and the comparison between the cost of equity and the weighted average of capital. It could be also, if you extend the question on the cost of equity level, the WACC level, and the cost of debt. So you have to remember 2 or 3 points here. The first one is on the comparison between the cost of debt and cost of equity. And when we say cost of debt and cost of equity, of course, we talk about the average cost of equity, because we can have different categories of equity. We'll see that later in equity issues. And you have different categories, different kinds of debts, depending mainly on the maturity, but also on the structure, for example, or currency and so on. That's what we said in the past session, in session 3. Why do we have a difference between the cost of equity, the average cost of equity, as we say very often, and the average cost of debt? Is because of one variable, which is the risk level. If the shareholders require a higher return than the banks on the markets for bonds, it's due to the fact that the risk of a shareholder is higher than the risk of a lender. So the cost of equity, total cost of equity, is always higher than the average cost of debt because of the risk level, which is different for a shareholder and for a lender. That means, of course, if you come back to my question, if you have a look to comparison between the cost of equity and the weighted average cost of capital, the weighted average cost of capital being kind of average, as is said, between the cost of debt and the cost of equity, the cost of equity will be always higher than the weighted average cost of capital. When you increase the percentage of debt in the weighted average cost of capital calculation, of course, you increase also the difference between the cost of equity and the cost, the weighted average cost of capital. It's always true. There is no exception there. Okay. Now, if I move to the preceding question, which is part 4, question 1, you have a question here, which is on the elements taken into account into the calculations of the costs of a weighted average cost of capital. The calculation of a weighted average cost of capital should integrate the average cost of short-term financial debt and the average cost of leasing contracts explained and discussed. So be very careful in what you do, and very often we find mistakes in analysis and diagnosis. The way you take into account that level is not the same when you analyze a financial structure and we make a calculation of weighted average cost of capital. Remember what we did when we calculated the debt capacity. We said a proxy. It is a proxy, of course. A proxy is to calculate two different ratios. The first one being the relation between the long and medium-term financial debts, including the financial lease, or equivalent debt of financial lease contracts. And this has to be compared to the total equity level. Okay. But in this calculation, we didn't integrate, of course, any kind of short-term debt, whatever they are, operational debt or financial debt. And we have the second ratio, which is another question here, which is the same value for the debt level compared to the free cash flow level. Okay. But when you deal with costs, you take into account all the financial debts, not the operational debts. Financial debt means you don't take into account the debt to the tax administration, you don't take into account debt to your staff, you don't take into account any debt to the providers, for example. You just take into account the debt with a characteristic which are financial debts, but take into account the long-term, the medium-term, the short-term financial debts, plus the equivalent debt of the leasing, financial lease contracts. That's what we did last time in one of the last exercises we went through. So the answer here to this question, is very easy. It is said the calculation of weighted average cost of capital should integrate the average cost of a short-term financial debt. The answer is yes. And the average cost of leasing contract, yes, for the financial lease. It's no, of course, for the operational lease. Okay. This is what we do. That's what I wanted to show you on this question for part 4, question 1. So we went through here 3 different questions, in order to come back to what we did in session 2, in session 3. I will be back with you later on the last question of the exercise we started with at the end of session 3. But what I want to do, and this is really the topic of the session, is to move, and we will move again. I hope if we succeed in moving, generally I fail, to 94 slide on equity issues. 94 on equity issues. I hope I will find that easily now. It's not this one, of course. Oh God. No, it's not the right one. It's always a bit difficult. Sorry for that, I find it. No, it's not this one again. Just a minute, please. No, it's not this one also. Tableau blanc, c'est pas ça. C'est pas ça. 93. I have to find it. Sorry for that. Oh, la, 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 geez. It's not this one also. Just a minute, I have to find it. I don't know where it is. I lost it. Sorry, but I don't find my slides anymore. Parti. Putain, j'ai perdu. Je les ai perdus. Non, c'est John 19. Parce que c'est pénible. Alors, c'est pas celui-là. Qu'est-ce qui s'est passé? Là, c'est 93. Sorry, I don't find my slide. Qu'est-ce qu'ils sont passés? Qu'est-ce qu'ils sont passés? Pourquoi est-ce que ça a disparu, ça? Ça, c'est 93. Impossible d'arrêter là sur 94. Ah, that's it. Sorry for that. I found my slides again. I hope you see my slides. So what I want to do is to move to the equity issues. I don't know where slides are there. Okay. So I hope you see these slides. So that means that after this introduction and 3 questions I dealt with, I want to move to the main topics for today, which is equity issues. We already went through the loans and debts issues, and I want to go into details on equity issues with an analysis of the policies behind and also a few calculations. We'll integrate also part of the theories we have in finance, you know. One of the main theory here being what we call the signal theory. And he will see in a few minutes what it means and how we can introduce this theory into the presentation. So we have different categories of equity and equity issue, but mainly we have 2 categories. I mean, we have kind of secondary kinds of issues, but the 2 main ones are equity for free and equity for cash. We will see also other equity issues through convertible bonds, payments of assets, and debt restructuration. And later we move to some different categories of equity issues with instead of ordinary shares, what we call preferred shares. So let's have a look first to the most simple issue, which is an issue for free. It seems in contradiction, you know, with what generally you think about equity issue. You think that firm issue equity, it's for obtaining cash. But you can, as a CFO, you can issue new shares for free. It is, if you have a look to point 1 here, there is no cash brought to the firm. There is just, you know, an increase in the number of shares. So, of course, you will ask why to do that, and we'll try to answer this question. It means if you increase the number of shares, but don't bring any cash or any increase in other asset, the balance sheet will not really move. At least the main categories of the balance sheet will not move. You will have a stability in the total of the balance sheet, both sides, of course. You will not have any increase in the level of the total equity. And as we have more shares, you understand that it is inside the total equity, that there is a kind of difference if you compare to the situation before, situation after to the situation before. So it's more a kind of accounting. It seems to be more an accounting consequence than anything else. There is no impact in cash. There is no impact in the total of the balance sheet. And point three, to manage this evolution inside total equity level, you need, of course, to make a transfer between the two categories of equity, two main categories of equity, which are the retained earnings and the equity level. Remember that total equity is made of two different elements. The equity level, which is made by the cash brought by the shareholders, and retained earnings, which is year after year part of the net earnings, which is kept into the firm. We have a firm being distributed through dividends to the shareholder. So it is a transfer. It is a transfer, and it is a transfer of what? Of retained earnings into equity. Now you increase the number of shares and you move part of the retained earnings into the equity. In terms of cash situation, for example, there is no consequence at all. In terms of the main equilibrium, this is point 4 here. In terms of main equilibrium, net working capital, operating working capital, and the cash level, just what I said, all these elements, equilibrium, are stable. And if all these elements are stable, all the main categories of calculation of equilibriums are stable, that means that the book value of a firm is stable. There is no change in the book value. You can have a modification, perhaps, in the market value, but no modification in the book value of a firm. That means you want to summarize in terms of financial analysis, traditional financial analysis, as we know very well now, which means liquidity solvency analysis, which means debt analysis, debt capacity, and the different categories of returns. It seems that there is no consequence at all. So the question remains, why to do that if there is no modification at all? Let's have a look perhaps to the motivations behind and also to the consequences. When you make an equity issue for free, say for example, I will issue one new share for all shares. That means that at the end of the process, you will have an increase in the number of shares by the percentage, which is summarized by the parity, is 1 out of 4. As we don't have any wealth creation or any cash creation, point 2, we have a reduction into the share price. We have a reduction into the share price. And that means these issues have a meaning if you want, as a CFO, to stabilize, for example, the price of a share at a certain level. If your net earnings, for example, are growing by 20% a year, that means if your price earning is stable, the value of a share will increase by 20% a year. And an increase by 20% a year, it's more than double, more than 100% in 5 years. So the question behind, what is the analysis our CFOs of growing companies, profitable companies? Do they want to keep the price of a share approximately at the same level in the medium term at least, or do they accept an increase into the price? What are the consequences on the equilibrium of the market? What are the consequences in the different categories of shareholders? This is clearly a problem of liquidity. This is clearly a problem of analysis, of policy, in the development, in the structure of the shareholders. So you see in point 3 what it means. It means if you want to have diversified shareholders, up to now, you have not been in this program into the analysis of what we call the shareholders group. It means for many companies, when you grow, you have different categories of shareholders. You find investment funds, banks, insurance companies, states sometimes, but also families and individual shareholders. And the question of diversification of a shareholders group is a question of importance for CFOs. Just because, different categories of shareholders, they don't have the same behavior. They don't have the same goal. They don't have the same horizon. Some of them are short term, some of them are long term. And it is clear that the stability of a shareholder group is a function of the diversification of the shareholder group. If you have at the same time individuals, investment fund, foreign, national, public shareholders, and so on, it is clear that they probably will not buy and sell at the same time. It means you will keep a liquidity level which is sufficient for anyone to buy or to sell shares of your company. It means also that, and this is point 4 here, this diversification and the different behaviors will help you to reduce the volatility of the share price. And volatility, as we know, and we'll come back on that again in different exercises, volatility is considered as a risk by CFO. As we know, you increase the liquidity level, and when you increase the liquidity level, generally you have positive impacts of the price of the share and the value of the company. If you increase the volatility level, you have an increase in the risk level and a decrease in the share price. In a simple solution to limit or decrease the volatility of a share price is a good solution and a positive solution for the CFOs, because one of the goals, of course, is to limit the risk, it's to increase the returns as in any other investment or financial process. So, point 5, when you increase also the number of shareholders, when you increase the number of shares, generally you increase the volume of the market and the liquidity level of the firm. And that is what I just said, when you increase the liquidity level, generally you increase also the price of a share and the value, market value, of course, not value of the company. We have many empirical analysis of that because it's not so obvious, So if you go into financial literature, academic literature, we have hundreds, of analysis of companies, with policies on the share price, policies on the diversification of shareholders, and you understand that when you issue new shares, you reduce the liquidity, you reduce the price of a share, you increase the liquidity, you diversify your shareholder group, you reduce the volatility, and at the end, you increase the market value of a firm. So, CFO, can have an influence on the liquidity level. It is clear, can have an influence on the volatility, and with policies in order to increase the liquidity level and to reduce volatility, they can create value, market value at least. Now, we can introduce what we call the signal theory. Each time you make a decision on your share, on the value of your company, on the diversification of a shareholder group, on the liquidity level, on the volatility level, you send a signal, what we call a signal. You communicate with the shareholders, you communicate with the market. And a signal has an impact on the behavior and the decision of the shareholders, and it can be a positive signal, it can be a negative signal, it can increase the value, it can decrease the value of a firm. Okay, so many decisions are signals in finance and have consequences on the market value of a company, market value of a share, of course. A dividend decision, which is communicated to the market and to shareholders, has an impact. Has an impact. It is also a signal. We will see later that a convertible bond issue is also a decision which is a signal given to the market, and generally has a negative impact on the value of the company. So all these decisions on liquidity, volatility, number of shares, issue of new shares, issue of bonds, issue and convertible bonds, they are signals and they have an impact on the behavior of the buyers and sellers, the shareholders, let's say, and consequences also on the market value. So this is the basic idea. We'll see in a few minutes, but when you do that regularly, I mean, if you are a firm which is a growing firm and accustomed to increase the number of shares, you increase regularly the level of liquidity, you diversify more and more your shareholder group, and you see that even if these shares are issued for free, there is an impact, a positive impact on the value of a company. So I've got number 4 here. When there is an equity issue for cash, what's happened? We are in a very different situation. And you can even argue that this is the only true equity issue. There is a counterpart. When you sell shares to the market, you sell shares to the shareholders. And on the right side of the balance sheet, you increase the level of total equity. On the other side, on the left side, you increase the level of cash. And of course, the total of the balance sheet is increased by the total amount of this issue. And if you increase at the same time the total level of equity and the level of cash, without making any kind of calculation, you understand that it is generally analyzed as a positive decision. Why? Because it means that the liquidity position of the firm is improved, and it means also that the debt equity ratio is improved. In many cases, we improve also, we increase the debt capacity. If you have a look to point 5, you understand that the impact in terms of financial analysis is on 2 main equilibriums, but not on the 3 main equilibriums. It is on the net working capital, because you increase the total liquidity level, and you don't increase the other elements. It means the long and medium term debt and the level of net assets. And of course, you increase the value of T, because you increase the value of the cash level, not of the short-term financial debt. But point 6, there is no impact on the operating working capital. The operations are not, the elements of the operations are not modified, whatever they are, inventories, receivables, or any of the debts on the right side, debt to the providers, VAT and debts to the tax administration, and debt to the staff. So no impact on the operating working capital, positive impact of net working capital, and on the liquidity and treasury position. That's what's really happened. Okay. Of course, you have an increase in book value. You have an increase in book value because when you increase the level of equity without any modification of the debts, you increase the book value of a company. But you increase also, and we see that into the calculation, the market value of a company. Means you have the same market value than before, plus an amount of cash. The increase is equal to the amount of cash which is brought to a company. So that means in terms of financial analysis, if we have to conclude here, it is point 8, you find several modifications which are globally positive on the debt equity ratio, of net working capital, the level of cash, and the level of T. But there is no impact or modification on some others, mainly on all the elements included into the calculation of the operating working capital. That's what we find here. If you, and this is a point I didn't deal with, which is point 4 here, and which is quite important to understand, and we see that also in the calculation in a few minutes. When you make an equity issue for cash, in most of the cases, the price of a share is higher. The level of cash you get is higher than the original value of a share in the balance sheet. That means, for example, have a look to your balance sheet and you see that in terms of book value, it is for 100 euros, and you sell the new shares for 150 because the firm has grown, better return, higher market shares than at the time. Of course, it was organized. You had the first balance sheet. So the question is what to do with the 150, and the 150 is split into 2 elements. New shares, which are valued on the initial book value, 100 euros, which means you have an increase in equity, which is 100 euros per new share. If you issue, for example, 50 new shares, it will be 100 multiplied by 50. And remaining part, which is the difference between the 150 euros and the 100 euros, which is equal to 50 euros, is included into a retained earnings level. It means an equity issue for cash generally, brings an increase into the level of equity and an increase into the level of retained earnings. And that's for the calculation elements, and we will go through these calculations in a few minutes. Okay, so that's for the two main categories here. Equity issue for free, equity issue for cash. Okay. So next slide here. We start still here on the equity issue for cash. And this is a summary of some of the consequences, and I already said a few words on some of them, but let's go through the different points again. Point one, we have in that case an increase of the cash amount available. And you understand that very often you make an equity issue for cash when you have a new investment to go through, a new technology to acquire, or when you want to finance easily an acquisition. Second, to improve the debt equity ratio. That is what I said. And when you improve the debt equity ratio, well, that means you increase your debt capacity in general, at least if you are a good return level, good cash level. And that means an equity issue give you the possibility to go back to the banks or to issue new bonds on the market. Point three, you improve. That means you decrease the level of risk. When you increase your level of cash, when you improve your level of equity compared to the level of debt, you increase, you improve, you decrease and you improve the level of risk. It's one basic technique to manage the level of risk of a firm. Point four, you increase, like what I said, the debt capacity level, and in general, it is equal to the level of the equity issue. You increase the firm value, book, of course, that's what we said. We increase the level of total equity, and you increase, in fact, the value of firm by the increase of the book value, which is also equal to the increase of a cash level. But you increase also the market value, at least on the level of the cash, which is broad. But don't forget that this is also a positive signal given to the market and to the shareholders. And they are, of course, raising the question of what will happen with that new cash. Perhaps the new cash will be invested into an acquisition or a new investment, which is supposed to bring new cash flows, and the net present value of these new cash flows, expected new cash flows, plus the value, the cash value, which is broad, increase the firm value. That means that in general, when the project is accepted, validated, I would say, by the market, the increase in the market value is higher than the increase in the book value, because the book value integrates only the increase in cash and total equity, but the market value increases, of course, these elements, but also the expected net present value of a future investment financed by this increase in cash. So that means also we send a signal to the market, which is very positive. We have projects we are moving up, and we are able to define the financial policy was adequate with the needs of the customers and the market. So you have at the same time the book value increase, you have the expectation of future cash flows discounted to the present time, net present value with future cash flow which is taken into account. And you have also something which is not calculated in fact, but which is a positive signals, positive communication. And the positive communication has a value even if there is no data behind. 7, an equity issue for cash is one way to refinance an acquisition. You know, very often acquisitions are opportunities. You use acquisitions to grow. This is not your first acquisition, but anyway, in many cases, you size opportunities. You don't plan your acquisition. It happens you plan, but in many cases it's an opportunity. So you have to decide very quickly to make the acquisition, and in many cases, at the beginning it is financed by the banks. It is financed by short-term debts, but we have to. The CFO has to refinance, to restructure, to consolidate this debt very quickly in order to come back to traditional equilibriums in the balance sheet. So an equity issue for cash is very often done also to refinance an acquisition which was decided very quickly and financed by short-term debt. And of course, the CFO had to find a way to restructure the right side of the balance sheet. Very often making consideration, it means making a swap between short-term and long-term debt, but after that moving the long-term debt into equity through an equity issue for cash. We'll see that in the M&A course later. It is also used to refinance losses due to a crisis. You have a crisis, and this is the case, for example, for airlines today. They didn't expect these losses, but flights were cancelled, the airports were closed during the pandemic, and they made tremendous losses. And the question was what to do with that. And the only way was to bring new cash. So sometimes we got loans from the states, from the banks, even from the shareholder. But it's clear that they had at the point in time when we recovered to restructure the right side of the balance sheet and to move these debts into new equity, because the losses, were deducted from the level of total equity. Total equity was reduced by the crisis. They were refinanced by that, and they have to come back to kind of standard and normal situation, increasing the level of equity. So equity issue for gas in the present time, are very often done also for restructuring the balance sheet of companies which are hurt by the pandemic. And of course, airlines is one of the best example we can get. Now, how it is organized? You have two categories of issues. Issues for free and issues for cash, but anyway, basic rules are the same. In most of the cases, and this is a general rule with exception, of course, original shareholders can get a priority to obtain the new shares which are issued, I mean to buy these new shares, okay? They get a priority. When it is for free, it's to obtain. When it is for cash, it's to buy. They have to bring cash, okay? But they have a priority. In some cases, and this is particularly done on some well-known stock markets, this priority is cancelled. That means that anyone, and it is true only for equity issues for cash, not for equity issue for free, and anyone can buy shares at the time they are offered on the market. This is generally done in cases the original shareholders don't want to bring cash, and when the level of cash needed compared to the value of the company is very high after a crisis, for example. So this rule of priority is always enforced for equity issues for free, and in most of the cases for equity issues for cash. And the only way to eliminate, to cancel, to waive, this traditional rule is to obtain before a decision in a shareholders meeting or the original shareholders. So they do that when they don't have any other solution, because they will be diluted, as we will see later. It is also a specific right. That means when you decide to make an equity issue, just at the moment you communicate that you will make an equity issue, immediately all the original shareholders, they get a specific right. A specific right is allocated to the original shareholders. This is what we call an equity right. That means the share is now divided into two elements. So the old share is divided into two elements, a new share and an equity right. And according to the accounting rules, at least, the total value of the new share plus the equity right is equal to the value of the original shares, just a split between two elements. Point 3 here, an equity right can be bought or sold during a transition period. It's around 7 weeks generally. It depends on the local regulation and national regulation, but it's around 7 weeks between the announcement and the closing. It means when the operation is announced, the original shares is divided into two elements, the new share and the equity rights, okay? And these two elements can be bought, sold on the stock market for a period, which is a transition period. And this period has a length of about 7 weeks. So we will consider here 3 periods of time: before the announcement, between the announcement and the closing, transition period, and after the closing, new situation. We will come back later on that to say, what is this equity right? It can be analyzed as an option, as a call. Technically, it can calculate the value through classical formula, which is based on the basic models of option valuation. What you can do with an equity right in some under certain parity circumstances or rules, you can obtain a new share in the issue for free, or if you bring the equity right or several equity rights plus cash, you can get a new share in the second case, which is the equity issue for cash. So it's a kind of compulsory element to participate to the issue with two different situations here. So I was 7 now. So now I will start with an exercise again. And this exercise, you get it anyway. I will show you the calculation, but you get the exercise also. It is in the final exam, June 2019. June 2019. It is part 5, and we have two subparts, which are A and B. So you received already these elements. Received the June 19 exam. I will read it for you here, and I will show you and explain the calculations and the consequences of the calculations. So we have a firm, and this firm is called here Alex. The Alex company plans to issue 1,600 shares for free. The shareholders own 8,000 shares before the issue. The last market price is 180 euros, and its nominal value is 100 euros. So you have basic elements, okay, on the number of shares, okay. On the issue, and you get the value, market value of a share before the issue. That's what you get here. Can try to show you where it is. I was afraid not to find my shares. It should be, it is in 2019. 2019 should be this one. Hope it is this one. No, it is not the right one. It is not this one. No, this one. No, it's not this. So you get it. You get it. So what we have here, you know, I show the calculation that you have in the exam. What you find here is a few questions, and the questions are the following. The first one is, what is the total value of a firm before and after the issue? Right? It's an equity issue for free. There is no cash brought to the firm. Okay, we know the number of shares before the issue. We know the market price of a share before the issue. We know the number of shares which are issued. We get, of course, the priority rule. And we know the nominal value, which is the initial value at the beginning of the story when the firm was created. Okay, that's what we know. So the question one is, what is the total value of the firm before and after the issue? So the value of the company is easy to calculate before the issue. value of a company, we are trying to calculate not a book value, we're trying to calculate a market value. Okay. So market value is, of course, the last market price, which is called P0 here, multiplied by the number of shares and 0. And we know in that exercise that we have 8,000 shares, and the last market price is 180 euros. So it's easy to make the calculation, and you find the result there on the screen right now, and it is equal to 1,440,000 euros. This is the value of a company in market price, not book, market, before the issue. What do we do here? We issue new shares for free. Okay, we increase the number of shares. We don't increase the level of cash. And we issue 1,600 shares for 8,000. We had 8,000 old shares. We issue 1,600, which means we are in an issue which is with what we call a parity of 1 for 5. It means that for 5 old shares, we issue 1 new share. 1 for 5. The parity is 1 for 5. This is classical presentation of an issue. So 1,600 new shares will be available and will be distributed among the original shareholder. And of course, as we said, there is nothing brought to the firm. There is no new cash. There is no increase in the total of the balance sheet, both sides. What does it mean? It means that the value, book value now, not market value, book value will not be modified. That means that V0, which was 1,440,000 euros, which was the value before, is also the value after, terms, at least if you calculate the market value, taking into account only the elements which are included in the balance sheet, without integrating any kind of consequence of the potential return of investment done with a new cash, or if you, of course, if you don't integrate any element coming from the communication, from the signal itself. That means that V1 in that case is still equal to 1,440,000. But now you don't get 8,000 shares. You get 9,600. 8 plus 8,000 plus 1,600, which is 9,600. So you get, and it is 3 lines before the end of the slide here, you get the new equality equations between the number of shares, 9,600, multiplied by the price of a share, and this is still equal to 1,440,000, which means the price of a share, easy calculation, is equal to 1,440,000 divided by 9,600. If you make this calculation, you find 150 euros. So the new price of a share is 150 euros. And what you understand is that this calculation, which is a proxy, even if it is based on the data coming from the accounts, is lower than the price of the share before. And of course, this is quite normal. If you increase the number of shares, but you still have the same value for the company, the price of a share should be lower. So P1 is always lower than P0. And this is an interesting point. Is it good policy to decrease the price of a share? And we come back to what we already said. If you want to diversify your shareholder group and to keep small or individual, let's put it that way, shareholders, you should be careful not to reach very high level for the price of a share. We have very good analysis, and it is empirical analysis. And don't forget that finance, is not only models or counting. Okay, it is models, and it is math, it is accounting based, but it is also very often behavior empirical analysis. And what we know it is that when the price of a share is increasing above a certain limit, which is very different depending on the culture, depends on the countries, depends on the wealth of the shareholders, the percentage of individual shareholders is decreasing. That means that companies, with high and regular growth over the years, and the example you find in the literature, for example, is very often Nestle, Nestle, Nescafe, Nesquik, and so on, in the food industry. They do an equity issue for free in average every 2 years, because they don't want to have a too high price of a share, because the decision maker think that if we allow the price of a share to be too high, probably the level of individual investor will decrease, and they want to get, to keep a diversified shareholder group, because they want to have different behaviors and not to be confronted only to large investors like insurance company, investment funds, and large banks. So, it's a clear policy. It's not only a problem of calculations. It's a clear policy which is depending on the behavior of the individual shareholders and the policy of the CFO and of the firm in terms of diversification of a shareholder group. Point 3, it's the value of the equity rights. This is another point. It's a technical point, this one, only. What's happened, it's an equity issue for free. We issue here 1 new share for 5 old shares. At the time the issue is announced, okay, if you are the owner of 1 share, old share, you get 1 new share and 1 equity right. It means your old share is split in 2 parts: a share, which we call new share, and an equity right. Okay. And with 5 equity rights, during the transition period, you can go to the bank. Generally, it's organized by a bank, and bring your 5 equity rights. And against the 5 equity rights, for free, you ask for a share. So the bank take your equity rights, give you a new share, and that's it. Okay? So you understand that if you can obtain a new share only bringing 5 equity rights. And as you know, the price of a new share being 150 euros, you know, the value of equity rights, what we call the theoretical value of equity right, to understand it is a proxy also, even if we calculate this proxy. It is equal to 150 divided by 5, which is equal to 30 euros. So that means, when the financial operation is announced, you can make all these calculations. And you understand that the equilibrium value of equity rights on the market during the transition period should be around 30 euros. Of course, you will raise several questions. Because the first one is, can you buy and share equity rights during the transition period of 7 weeks? And the answer is yes, you can buy and sell. I mean, you can say, for example, I know this company, but I was not a shareholder before the announcement. And at the time the announcement had a look to the balance sheet, income statement, returns, risk, and so on. And I'm interested in becoming an investor, becoming a shareholder. What can you do? You can buy, of course, new shares, 150 euros per share. But you can also buy equity rights. And if you buy a multiple of 5 equity rights, you can buy your equity rights, go to a bank, ask for new shares. For example, if you buy 20 equity rights on the market at the price of 30 euros, you can go to a bank, bring your 20 equity rights and ask for 4 shares. Of course, this is a question of arbitrage, comparison and arbitrage. If at the point, because the market is not very liquid and the arbitrage is not so good, the price of equity rights on the market during the transition period is less than 30, you have better to buy equity rights and go to the bank instead of buying directly a new share at 150. Okay. So that's how it works. And of course, the second question you will raise, the second question you will raise is about the investors will not get the right number of equity rights, which means a multiple of 5. If you are an original investor, shareholder, with, for example, 7 shares, and there is the announcement of the equity issue for free, what can you do? Of course, you can use 5 out of 7 of your equity rights, go to the bank and ask for a new share. That is something you can do. And you will get a new share. So you get at the beginning 7 old shares. At the time of the announcement, you get 7 new shares plus 7 equity rights. You use 5 of them. Now you get 8 new shares, but you still have in your hands 2 equity rights. And you cannot use 2 equity rights to obtain a share. The only things you can do is either to sell on the market your equity rights and you will get some cash, or to buy equity rights. And as you add 7 equity rights, you use 5 of them, you still have 2, you can buy 3, get now 5 more, and go back to the bank and ask for 1 new share. So if you sell your equity rights, you will get only 6, you can 1 more share plus cash. And if you buy equity rights, you have to bring more cash, but you get two more shares. It means if you start with 7 shares, 7 all shares, of course you will get 8, okay, but perhaps you will get 9 at the end. If you get 8, you get cash also. If you get 9, you have to bring more cash. So this is the arbitrage you can do on the markets and how it works. Now we have here another slide, which is slide number 8. No. And slide number 8 here is dealing with an equity issue for cash. And if you go back, if you go back to your final exam, part 5B now, we can read it and we can have a look to the calculation which is here on the slide. So let's read together, this second part of the exercise, still the same, which is June 19, part 5B, B part. A few months later, the financial manager plans to issue 1,600 new shares. Again, new shares are not the same. It's new shares. It means we had 8,000 at the beginning. We issued 1,600 for free. And now we are issuing 1,600 for cash. Okay. So financial manager plans to issue 1,600 new shares at a price of 140 euros. And the last market price before the issue is 160 euros. Okay. So the first point you have to be very careful here is that, of course, it is a few months later. That means before the closing of the equity issue for free and the decision, the announcement to make another issue and an issue for cash, the situation of the firm, the economic situation globally, the state of markets, can be different. That means the market value of a company, could be different because the share price is now different. And what we understand is that here, the share price has been moving. Remember that it was 180 euros before the first issue. It's supposed to be, in terms of, according to our calculation, 150 at the end of the first issue. And what we know is that a few months after, just before the decision to make a second issue, it is 160 euros. Now, it's not a tremendous modification, but it's not exactly the same price. So if you want to calculate your market value of a company, which is V2 here, just at the time of the announcement of the second issue, you have to take into account the price of 160, which is the market price, the last market price, just before the announcement. And of course, you multiply the 160 by the number of shares. The number of shares include not only the ordinary number of shares, but the total of these ordinary all shares, 8,000, plus the ordinary shares you have issued, in the preceding issue, which is 1,600. So that means you have 9,600. And the value of the company is equal now to 9,600 multiplied by 160, which is 1,536,000 euros. So that's the market value of the company at the time of the announcement of the second operation. That's where we are. And now what we know is that we will issue, a number of shares, which is again 1,600. But 1,600 has to be compared not to the 8,000, the original number, but to the existing number, which is 9,600. And if you divide 9,600 by 1,600, it is equal to 6. Then that means we have a parity in this new issue for cash of 1 for 6. Remember that it was 1 for 5 in the preceding calculation. And we know that in this issue of 1,600 shares with a parity of 1 for 6, the price of the share, which is sold now, each share sold brings cash to the company. The price is 140 euros. But meaning that if it works, we have an amount of cash here, of new cash, which is what you find here as V3, and V3 is equal to the new number of shares created, 1,600, multiplied by 140, the price of a share, which the shares which are sold on the market. But if the amount of cash is equal to 1,600 multiplied by 140. And this is quite interesting here because it brings 224,000 euros to the company. So it would say very simply, taking into account only these elements of calculations, what is the value of a company afterwards? What is the market value of a company afterwards? It's equal to V4 here, which is the total of the value before, we have already calculated, taking into account the last market price, plus the amount of cash which is brought to the company. That means it is equal here, and you see that on that slide, it's very clear, I think, to V2 plus V3, which is 1,536,000 plus 224,000. And we have a total value after the issue, which is 1,760,000 euros. So we have an increase in the value of a company. When you go through the calculation, you understand that the increase in the book value, the market value, as they are calculated here, are the same. They are equal to the total level of cash which is bought, 224,000. Okay. But you understand also that probably, according to what we said on the preceding slides, a few elements are not taken into account in the calculations of market value. If your explanation, presentation are very clear to the market and to shareholders, and you will argue that with this new cash, we create new value. Of course, the net present value of the future cash flows coming from these new investments should be included into valuation. That means that V4 is a kind of proxy of the value of a fair market value, but probably if you are successful and you convince the shareholder group, it will be an undervaluation of the market value. Because of this net present value, our future cash flows coming from the investment of this new cash. You can also argue, and this is one of the arguments of those working on signal theory, is that you are making or giving regularly financial operations like this one, equity issue for free, equity issue for cash, and you have clear goals, in order to maintain the share price in a certain range between limits, and that you have goals also in making a diversification of your shareholder group. And also because you make this issue, give a kind of proof of your dynamism, good knowledge of how to use market. And that this is a positive signal, and a positive signal has a value. And this is the second reason why, we can argue that this total value which is calculated is undervalued. So it's a pricey, but probably also pricey, which undervalue by a few percent the potential market value of the company, what is behind, and the discussion is really there. So if you have analysis of that, that means one of the quality of a good CFO is to be able to sell to the market and to the shareholders the fact that they is taking into account the problems of liquidity, of volatility, of diversification of a shareholders group, of forecast of what will be done with the new cash obtained in terms of new project, new cash flows, new net present value of the new cash flows, and of course, and it takes into account all this, the real data takes into account the quality of the management of the CFO, its dynamism, quality of communications, and so on. So that's the reason why we argue that this calculation for good shareholders, for good CFOs, they undervalue the real market value of a firm. And of course, this has been tested, and thousands of tests, and it's clear that in a large majority, the result of the test is positive. Okay, so this is where we are. It was slide number 8. We have a slide number 9 here. We have a slide number. So what we have done, it's calculating, the values. Now we have to go into more details and more calculations, and to calculate the price of a share, and to calculate also the value of equity rights, and the policies which can be chosen by different shareholders. So we are here with number 9. So it's nearly, for you, it's nearly 4. For me, it's nearly 11 in the morning. I suggest we have a short break, 5-7 minutes, before moving to the other calculations, trying to explain them and their consequences. Thank you. So, short break, please. Bien, très bien. Ça, c'est cool, là. Je pense que ça va vraiment bien. Okay, I think it's time, to start again with the last hour here, and we made a calculation of the value before and after here with the second part, in B part of the exercise. It was slide number 8, and now we have to move to other simple calculations in the second case also with the issue for cash. And of course, if you go back to the exercise itself, what is asked, and it's a very classical question, is what is the expected price of a share after the issue? And next, it will be what is the theoretical price of the equity rights, of the two main elements. Okay. Remember, you have an all share, the announcement, beginning of a transition period, and the owner of the all share gets now a new share and an equity rights. And of course, if all the conditions and information available to the market, to the shareholders, the same, we make the assumption that the value of the equity right and the new share is equal to the value of the all share in terms of market share. So, what is the price of a share after the issue? We have made a calculation before of V4, and V4 is here on the last line, is 1,760,000 euros. And now we have an increase in the number of shares because we had 9,600 shares at the beginning of the issue, and we added 1,600 new shares. It means the total number of shares is now 11,200. So we moved before the first issue from 8,000 to 9,600 after the first issue, and now we have 11,200 shares. You just have to make the calculation here, and you divide V4 by N4, and when you do that, you find 157.14 euros. So that's the new price of a share after the issue, calculated with the elements we know. Now we have to calculate the theoretical value of the equity right. And to do that, we have to understand what's happened. First, we, as we mentioned before in the preceding slide, we have a priority of 1 for 6. 1 for 6. It means one new share for 6 old shares. So let's take what's happened. We know that the new share is sold for 140 euros. So if you want a new share, you have to go to the bank and bring 140 euros. But you need also to bring at the same time equity rights, taking into account the priority. I mean, if you want to get a new share, you have to put on the table, 140 euros cash plus 6 equity rights. And the counterpart, what you obtain is a new share, and we know the theoretical price of a new share. We just calculated this price at the beginning of that slide, which is 157.14 euros. That means for 140 euros in cash plus 6 equity rights, you get a new share. The value of a new share is 157.14. That means you can calculate easily the value of the 6 equity rights, which is 157.14 minus 140, which is 17.14 euros. But this is for 6 equity rights. Now, if you want to calculate the value of one equity right, you have to divide by 6, and you get something like 2.85, which is very small value. You understand this is always the case, and it is clear that the value of the equity rights is much lower in the equity issue for cash than in the equity issue for free. And if you compare both cases, it is very clear because of the cash, of course. So now you know the value of a company before and after. You know the price of a share before and after. You know the price the price of a share at the time it is issued, new shares. You also know the nominal values. You know the value of the equity right in the first case, in the second case. So we have already made several calculations. Now, let's go into what can happen for a shareholder. We are still in the equity issue for cash. And can have a look to some example. Let's take a shareholder with 6 shares before the issue, and that shareholder, who is in a very simple situation, it is in a situation of having a portfolio which is a multiple of a parity, which is the easiest situation in terms of arbitrage. So if he has 6 shares before, he has got a value of a portfolio which is 6 old shares multiplied by 160 euro, which was the market price, remember, just before the announcement of the second issue, the issue for cash. That means he owns 960 euros. Now, after the announcement, and it means at the beginning of the transition period, now he has 6 new shares plus 6 equity rights for 960 euros. Okay, and with 6 equity rights and 140 euros, he has to bring cash again. He gets 1 more share. Okay, so let's make the hypothesis. He choose to do that because, of course, he could have chosen to sell the equity rights also and to get cash. But here, in this hypothesis, he is in the situation, he has a portfolio of 7 shares, and the value of portfolio is 157.14 multiplied by 7, which is 1,100 euros. Okay, so the increase, of course, in value is equal to the increase the cash which has been brought by their shareholder. Here, the portfolio of 6 new shares plus 6 equity rights for 960 euros. Okay, and before he had a portfolio of 6 old shares at the price of 160 euros, which is also equal to 960 euros. He decides to use the equity rights to bring 140 euros, and he gets, of course, 1 more share. And at the end, he has got 7 shares, and 7 shares with a price for the shares, which is 157.14, what was already calculated, which is equal to 1,100 euros. And if you compare 1,100 euros, which is the value of portfolio now, to the 960, the value of portfolio either before the announcement or just after the announcement, we have a difference of 140, and the difference here is equal to the level of cash which has been invested, which has been brought by the shareholder. So he has invested, in fact, in the process, 6 old shares, his portfolio before the announcement, and cash for 140 euros, and year 10, 7 new shares. Well, now let's There's a small question, which is quite important for following elements in the exercise. If you compare both portfolios, huh, that means at the beginning, before the announcement, he has got 6 all shares for a price of 160 euros, which is 960 euros in shares, and of course 140 in cash. 140 he will bring into the process. So the total amount of 1,100 euros is made of a large percentage of shares and a small percentage of cash, but we have shares and cash. Shares for 960 and cash for 140. At the end of the process, the value of portfolio is the same, 1,100 euros. But the portfolio is made only on shares. He has got now 7 new shares, and there is no cash anymore. So this is the same value, 1,100. But before it's a large percentage of shares, small percentage of cash, and after it's 100% of shares. So the question behind this is what about return and risk? Both portfolios have the same value. But of course, if you say, for example, the market price, stock market will increase by 20% in the next 3 months. It's happened sometime. What will probably happen here, its price of a share will also go up. And both portfolios' values will not increase the same way. A portfolio which is made of 100% of cash has a value which will increase quicker and more than the portfolio which is split between shares and cash. That means the potential return, of the portfolio only invested in shares is higher than the potential return of the portfolio which is split between cash and shares. But at the same time, and this is what normal we consider financial theory, but at the same time, the risk is higher because if the stock market declined by 20%, probably it will impact on the portfolio of 100% of shares will be more important than the portfolio which is partly invested in shares and partly invested in cash. So the conclusion is very simple. Both portfolios have the same value. But the second one, portfolio which is only in shares, 100% in shares, shows a higher return and a higher risk level. And this is the conclusion we can have here. Now let's move to question number 4 of the exercise, B4, part 5, same exercise, June 2019. And the question is the following one. What are the consequences of these 2 issues on the balance sheet of the company? Retained earnings were 700,000 euros before the first issue and increased, retained earnings increased by 40,000 between the 2 issues. It means we already had 700,000 level of retained earnings coming from past net earnings split between dividends and retained earnings. And between the 2 issues, we had several months, and perhaps we had a positive net earnings in the meantime, and part of it for 40,000 was integrated into the retained earnings. That's a very classical situation. Okay, so we want to understand and to summarize the situation and to understand what's happened before issue 1, after issue 1. before issue 2 and after issue 2. That's what we want to understand. After that, we have a look to the market value, book value ratio, which is a very classical ratio we know very well. Okay, so let's start with what's happened before issue 1. Before issue 1, we have a situation which is the following one: 8,000 shares with 100 euros nominal value, which means the equity is 800,000. Okay. You understand, of course, that the equity level will be always calculated with the value of a share, which is the nominal value. So 800,000 multiplied by 100, which is 800,000 euros. And as we know, reading the question 4, we have 700,000 retained earnings, which is total equity of 1,500,000 euros. Very easy. And no comment on that. After issue 1, what's happened? Remember, that is an equity issue for free. It means there is no charge with the cash level, no charge with the total equity level, no charge with the total balance sheet, and so on, no charge over different equilibriums. But we have an increase in the number of shares, and the number of shares is 9,600. Okay? So the equity level now it's 9,600 instead of 8,000, multiplied by the 100, which is the nominal value, which is 960,000 euros. But the level of total equity is still the same, 1,500,000. So that means if you want to maintain, this equilibrium, you have to reduce the level of retained earnings. You can calculate now the level of retained earnings by making the difference between the total equity level and the equity level. 1,500,000 minus 960,000, which is equal to 540,000. This is retained earnings. What's happened, in fact, when you consider these small limited calculations, is that you have a reduction, a decrease in the level of retained earnings. And the decrease in the level of retained earnings is equal to the difference between 700,000 and 550, which is 160,000. And 160,000 is equal to what? Is equal to the number of shares, new shares, 160 multiplied by the nominal value. But in fact, we have integrated the new shares at the nominal value in the equity. And as the total equity will be the same, we have decreased the level of return. It's a kind of transfer between retained earnings and equity in accounting terms. That's all. Now, let's move to following situation, which is before issue 1. It is before issue 2. It's line number 12. And we have a situation which is a bit different here in accounting terms. I said in accounting terms. Not to make a confusion, we have a difference in terms of market value because we had an increase in the market price of a share between the end of the first issue and the beginning of the second issue. We have an increase in the market value price of a share from 150 to 160. But this is not the problem here. We are in accounting, okay? And we still have, we are just before the issue, we have still 9,600 shares, and we have a nominal value which is still 100. So the equity level is stable here. It's 960,000. But what about retained earnings? We start from the preceding number we have found here and explained, which is 540 for retained earnings, and we should add the increase in retained earnings, which has been done between the end of the first issue and the beginning of the second issue, which is 40,000, as it is said in point 4b, B4 of the exercise. Okay, so now retained earnings is 580, which is made of 540 plus the 40,000 coming from the increase in retained earnings, which is explained here. So that means we have a small increase of the total equity level, small increase, because we had the positive net earnings and we were split between dividends and retained earnings. And as far as retained earnings is concerned, we have an increase of 40,000. So this is before issue 2. Now, what's happened after? After issue 2, we have an equity level now which has increased because we have an increase in the number of shares. Another 1,600 shares were created. So we have 11,200 shares. And we still have the same nominal value, 100, which means we have here now 1,120,000 euros for the level of equity. So what about retained earnings? It's a bit more complicated here. Because we start, of course, from the 580,000 calculated above in point 3 on that slide number 12. But we have to take into account what's happened with this new issue. When you issued your share here, and you issued here 1,600, when you issued your share, the firm received 1,040 euros. And what's happened with 140 euros actually? What's happened with the 140 euros per share? 100 euros is integrated into the equity. It is the nominal value part of the price. But the firm receives 140 euros, not 100 euros. It means you have 40 euros more. And these 40 euros should be somewhere, The increase in total equity for one share is 140. So if you have only 100 in equity because at that level the share is priced at the nominal value, 40 euros have to go somewhere else, and the only place where it can be integrated, it is in the retained earnings. So what you have to do is to increase retained earnings by the amount of shares, number of shares which are issued, which is 1,600, multiply by the difference between the price, 140, minus the nominal value, 100, which is equal to 40. And these product, 1,000 shares multiplied by 40 euros per share is equal to 64,000, what you find here on the second line, or part 4. So the total of the retained earnings now is equal to the initial number, 580, plus 64, 580,000 plus 64,000, which means that the total of retained earnings has increased now from 580,000 to 644,000, just because we have this problem of difference between the price obtained from the issue per share in the issue, and the nominal value. And you have to make the total, and total equity is increased. It is now 1,764,000. If you put it another way, you have an increase in the cash level for the firm, which is equal to number of shares which is issued, which is 1,600 multiplied by 130, and 1,600 multiplied by 140 is equal to last line here, 224,000, and the 224,000 increase in cash and increase in total equity is divided between two elements, 160,000. It means 1,600 shares multiplied by 100, the nominal value, and the difference, the 40 left, multiplied by the, again, 1,600, which is equal to 64,000. This is what you see in that calculation here. Okay. Now, what you can do, it's a calculation of the market value over the book value before issue 1, after issue 1, before issue 2, after issue 2. This is a very classical calculation. And we know that it is quite interesting how we know the importance of this ratio, what it means. We have been through that explanation several times. So we can make the calculation here. And what do we see when we do that calculation? We understand that it's relatively stable and close to 1. It means market value is not very high compared to book value and doesn't integrate, an impact, of the future issues, which probably means that at least for in point 3 and 4, there's, if the decision of the firms and the CFOs are the right ones, undervalue the market value. Because if you even invest, the new cash in profitable projects, this will increase the cash flows, increase the net present value of future cash flows, and should increase the market value, which is not taken into account, in that kind of calculation. So when market value to book value is nearly equal to 1, it means, that in fact, in the calculation, we don't integrate any value creation in the future, just keep a value level. But in fact, it's probably an undervaluation for a reason I already explained, on the allocation of the funds which are obtained, and the cash flows and net present value of the cash flows which will be obtained in the future, plus the consequences of the signal positive signal which is given to the market. Now, let's have a few words on dilution and reduction. Let's have a few words on that. If you read your textbook, Burke and DeMarzo, you can find explanations and measures on dilution. And very often in analysis, particularly in acquisitions and consequences of acquisition, it is measured by the earning per share. So the earning per share is supposed to give a good measure because in the short term, the price earning is supposed to be stable. But when you multiply the earning per share multiplied by the price earning, you get the price of a share. So if you increase or decrease the earning per share, you have an immediate impact on the value of a share and the value, market value of a company. If in an investment point 3, an acquisition, for example, there is a decrease in the earning per share, it means that there is a decrease in the wealth of the companies and the wealth of a shareholder, and there is a wealth dilution. If, on the contrary, an investment, an acquisition, for example, increases the earning per share, it means there is an increase of the wealth of a shareholder. This is what we call wealth dilution. In fact, when you have a look again to what's happened in many cases using empirical analysis, you understand that in many acquisitions followed by mergers, there is first a dilution. It means a decrease in the earning per share because we have cost of transaction, cost of financial costs. And if you are waiting for synergies are not coming immediately, they are coming 1 year or 2 years or 3 years after. So immediately you get a negative impact, a negative impact of the earning per share in many cases. But after that, if you are successful in managing the acquisition and your forecast on synergies of sales, synergies of cost, increase in sales, decrease in the cost level, you find what we call a dilution. It means an increase in the earning per share. So in many cases, wealth is going down, is decreasing, and then is increasing. And it is what we call the dilution effect, and followed by a dilution effect, dilution consequence. So this is what we try to measure in many cases. We find this again, in the course on mergers and acquisitions. If you consider what's happened, and compare what you find in your textbook and when you find in interview, discussion with CFOs, you understand that dilution and reduction is not a central topic in the textbook. Of course, you find the words, you find calculations of an earning per share. Very often, reduction is not even known in the textbook as a word. But these two elements are priorities for CFOs. Now, if we take into account the second dimension, not the wealth dimension, but what we call the control dimension, the situation is a bit different. in the textbook, very often it's not a topic at all. For the wealth, we talk about dilution. Very often, dilution is forgotten. For the control, you try to find in the index what where it is. It's even not studied. And for CFOs, it's also very important. That means CFOs, they are dealing and managing at the same time, the dilution evolution of wealth, dilution evolution of control. And what is the dilution evolution of control measure? We know that for wealth, it is mainly the earning per share. It is the percentage of shares of rights of vote which is owned. Your control is the control of the majority in the annual meeting of a shareholder. That means that point 3 here, if an investment, an acquisition, for example, reduces, the number, the percentage of rights of votes in the hands of a shareholder, it means there is a decrease of shareholder control power. This is what we call a dilution. So we are very careful when we make an investment or an acquisition and of the consequences of this decision and that financial package which is used in terms of rights of votes, in terms of percentage in rights of votes in the next annual meeting. And very often when you make, large investments, you are obliged to issue new shares. You are not always, original shareholder not always able to bring new cash. There is a dilution of the percentage of rights of vote, a dilution of the power of control. Point 4, if an investment and acquisition, for example, increases the number of percentage of rights of vote in the hands of the shareholder, it means there is an increase of a shareholder control power, a dilution. That means generally when you finance, mainly by debt, you manage more easily this element. Because when you finance by debt, you don't issue new right votes and you don't modify or marginally only the percentage of rights of votes in the annual meeting, don't move the power of control. The problem is that for CFOs, dilutions and evolutions of wealth and control have to be managed at the same time. When you decide to make a large investment, you make an acquisition, you use very often different financial resources, debt, equity, and you have to measure the consequences, short term, medium term, on the wealth of shareholders and the control of the annual meeting with power control. And this is one of the most difficult points to deal with in financial engineering. That means if you come back to our topic, when you make an equity issue, you have to be very careful of the consequences in terms of dilution, evolution, of control, short term and medium and long term. This is one of the difficulties you have to integrate into your choices of equity issues. And you have to integrate it not only in the very short term, but also in the medium term. And we'll see later in our courses, mainly in M&A, but one way to manage that kind of situation is to use hybrid products to increase the debt capacity using leasing contracts, and also to use other hybrid products like convertible bonds, which are very popular, but also preferred shares. And very often in difficult situations, we use at least 2 of these 3 main families of hybrid products to manage this process and to package the equity issue. That's just what I wanted to show you here. And we are moving from calculation, arithmetic calculation, something which is more higher level, in terms of financial policies. This is a good transition or introduction, to the M&A course. So I have a last slide. I've got a last slide for you here now. And if you want, you're able to come back to one or two few questions before we leave today. I ask you to come back, and you can do it by yourself, to question 1, June 19. Now, it's always, all these questions are coming from the two exams I used, June 19 and July 20. And this one, the first one, is coming from June 19, part 2, question 1, which is a very classical question. I read for you the question, but probably you get it in your computer. In an equity for free, there is no dilution of wealth or control, percentage of rights of vote for the existing shareholders. Explain and discuss. In an equity for free, there is no dilution of wealth or control, percentage of rights of votes for the existing shareholder. Explain and discuss. So what's happened? You are shareholder, original shareholder, old shareholder, if you prefer. And there's the announcement, as we read in the exercise. And there is an equity issue for free with a criterion of 1 for 5. What are the consequences? You get immediately a new share, and you get an equity right. And if your portfolio is made of a multiple of 5 shares, it's easy for you to solve the problem. You take your equity rights, go to the banks, and get immediately a certain number of new shares. And your increase in new share is such that your percentage of shares in the total number of shares of a company will not change. That means as the net earnings of the company has not moved, of course, your earning per share will decrease, but the total earnings of your portfolio will still be the same. So there is dilution at the level of 1 share, but there is no wealth dilution at the level of your portfolio. It is same amount of earning per share at the level of your portfolio. Simply, instead of being, for example, split into 5 shares, it's split into 6 shares. No difference in terms of wealth. Now, in terms of control, what will happen? Of course, you will get 1 more share. If you got at the beginning 5 shares, now you get 6 shares. You get 1 more right to vote, but there is no reduction just because the total number of rights to vote in the company has increased in the same percentage. That means your percentage of rights of vote compared to the total number of rights of vote in the company is still the same. So there is no dilution, there is no reduction of rights of vote. So there is no dilution, no reduction in terms of power of control. There is no chance, here in terms of dilution, reduction of wealth, dilution, reduction of control. It's completely stable. The only thing which can happen, and which is very, very marginal, it is that instead of getting 5 shares, you get 7 shares. And you decide either to buy or to sell equity rights. And of course, in that case, you will move, and have obtain a small effect, consequence on the level of earning per share you get and the level of rights of vote. The impact is very limited, so it is marginal. So if we conclude saying, okay, when we have a portfolio which is made of a multiple of a parity, we don't have any consequence in terms of dilutions of relations at the level of wealth or level of control. We have very limited consequences when we have a portfolio which is made of a number of shares which is not equal to the parity. But you understand that if the parity is 1 for 5 and you get 53 shares, the problem is only on 3 shares out of 50, which is in terms of consequences very, very limited. So main conclusion is that equity for free, in general, you don't have either a consequence in terms of dilution or dilution of wealth and control, or very marginal consequences. This is what you can conclude. Let's have a look to the other, exam, because we have also a July 20 exam, and you have here a few questions, and one of the questions is very interesting because it brings, another point here, which is July 20, part 2, question 1. And the question is the following one: when the dividend of the company is paid in shares, there is no dilution of wealth or control for the existing shareholders. Explain and discuss. So what does it mean? It means at the end of the year, you have a positive net earnings, and it is decided by the annual meetings of shareholders that this net earnings will be split between dividend, perhaps for 40%, and retained earnings for 60%. So there is no problem for retained earnings, classical way of to deal with the net earnings. But there is a problem with dividend. Now you have a dividend, it is decided that 40% of the net earnings will be distributed through dividend. But a choice is given, generate a choice to a shareholders, either to get the cash and to have a dividend distributed in cash, or to have, the dividend paid in shares. What does it mean? It means that there is an equity issue. New shares generally are created because for the shareholder asking for dividend paid in shares, the company needs new shares, and it creates shares in the number which is needed, depending on the level of a dividend to be paid, and also after that of a decision of a shareholder. So you have new shares created. Okay, and in front of these new shares, there is no cash. There is no cash. That means, it works like an equity issue for free. You have an increase in the number of shares. You don't have any increase in the total in total equity via an increase of the dividend only. And you come back to the cases we already studied. That means if you increase the number of shares, but you increase also the cash brought, it will depend on the level of cash which is brought by for one share and of the value of a share before. And generally at that level, there is a dilution of wealth for the existing shareholder, okay? And we have also an increase in the total number of rights votes, okay? And that can mean, depending on the decision of each shareholder, either a decrease in their power of control or stability of their power of control. It depends mainly on their decision. So it's a more complex case for the calculations, but generally at the end of the process, we have a decrease in the wealth, small dilution, and we have a decrease in the power of control. But this is generally very limited because the level of dividend paid in shares is very limited to compare to the level of total equity. So this is what we can say for that question. So I did what I do generally, in that kind of session. It was session number 4, mainly centered on equity issues. I went back on a few points to summarize what we did in session 3, went through a few questions, 3 questions in that case, on what we did in the preceding question to have a transition with session 4. Other I choose to concentrate on equity issues. There are different consequences in terms of calculations, equity issues for free, equity issues for cash. The signal effect also, the undervaluation, which is generally measured through empirical analysis, because we ignore the consequences of good investment in terms of the present value of future cash flows. We went also through a few ideas of about dilution and evolution, which are a good transition, because they are mainly coming from equity issues, the dilution and evolution, and they have a great impact on the financial decisions, globally, but also on how to finance operations like acquisitions and mergers. We also identify that we have 2 categories of dilution and evolutions. The classical dilution of wealth and evolution also, which is less classical in the textbook, but also, dilution and evolution of control, and understood that we have as a CFO to manage at the same time both dilutions, dilution of wealth and dilution of control, with the short-term consequences, but also immediate-term consequences. And we understood through empirical analysis that very often in financial operations, we have dilutions in the dilution of wealth in the short run, then evolutions in the long term. And but one way to deal with that is to use also hybrid products, like convertible bonds, leasing, and preferred shares. And we'll go into that kind of elements in the next sessions. So this is what I wanted to do for today. We are at the end of session 4 now. We have another set of slides for session 5. Session 5 will take place in the very short term, because it will be on Monday. That will be the last session of that course. And we introduce new elements like interest rate, leverage, valuation, and again, the architecture. You know very well that's architecture, connecting all the elements we have been through, and will be a preparation of your assignment, which will be again, as you know, on biotechnology case. Yeah. So, excuse me. That is what I wanted to do today. For you now, it's quite late. It's about 5 p.m. So have a nice evening, nice Sunday. Take care. Hope you are doing well, and your family and friends also. But take care, and we will meet again. On Monday. For me, it will be 2 p.m. and for you, it will be 7 p.m. As in the past session. So thank you very much for being there on the Saturday afternoon, and we meet again on Monday. Thank you very much and goodbye. No question? Tram, you are still there? Or? Okay. No questions. So goodbye.